Hi everyone, today we're going to be talking about the in and outs of tax-free savings accounts. Please be advised that none of the information discussed here constitutes as financial advice. If you are looking for financial advice, follow the link in the description box to book an appointment with us. My name is Matumelo. I'm here with Christopher Yoon and I'm here with Justin Joseph. Justin Joseph is from 91 and he's a product specialist. Welcome, Justin.
Thank you so much for having me. Very excited.
Thank you so much. Can we talk about what you do at 91 to give people a little background on who you are and what you do as a product specialist?
Perfect. So I'm a product specialist at 91, as you stated, and we were previously known as Investec Asset Management. We are an investment platform in South Africa and globally that houses a range of different sorts of products to assist clients to invest their money and preserve money for them going into the future. And we try and create different structures and different products to help assist advisors, firstly like Christy, to give good advice and hopefully give them better outcomes going forward in their financial planning.
Fantastic. Because we're talking about tax-free savings accounts, I think it's best that we talk about the history or the origin of tax-free savings accounts. In 2015, the government introduced them, and let's talk about what the purpose of the product is and how it has fared throughout the years.
Perfect. So the tax-free savings account was brought in from the government to try and motivate South Africans to invest a bit more, and firstly try and give them a convenient type of way to invest. So try and, how can I say, let's say that people don't want to invest in certain products because they're going to continually pay tax, such as your bank accounts and your money market. So the government said, okay, let's create a structure where we can provide our clients with tax-free growth and hopefully motivate them to save more. And the main reason for this is actually to try and create savings over the longer term from South Africans to help supplement their need for retirement savings at a certain age. Because as we all know, South Africa has a very poor rate of people who can actually retire.
That's true.
On their own, and everyone who can't retire on their own obviously needs help either from family or from the government, which puts a lot of pressure on them. And that's why they're trying to build a motivational product like the tax-free savings account.
So would you say there is a specific target market for tax-free savings?
I think there is a target market, but I think it can be used quite generally, the tax-free savings account. But the tax-free saving account is more for your longer-term investor. So it's someone who's going to invest over the long term and doesn't need the funds, say, quite regularly, because in the beginning, because you want to actually try and benefit from the tax-free growth that you receive. And I think we'll see with the rules regarding a tax-free savings product and the constraints that it has, it's built around to try and get clients to invest for the longer term.
Speaking of rules, what are the general rules on investing in a tax-free savings account?
So tax-free savings account, the client can invest a maximum of 36,000 Rand per year or up till an amount of 500,000 Rand over their lifetime. The nice thing is that there's no restriction over the period that they're allowed to be in the tax-free savings. So let's say I've over 18 years contributed my 500,000 Rand, I can stay in the tax-free savings for another 18 years if I'd like. So there's no restrictions on the maximum term. I think one thing that's important regarding a tax-free savings is if I go past that 36,000 Rand per year,
yes,
I'm going to pay 40% tax on what I would contribute. And I would say that the main reason because of this is that obviously with it being a tax-free savings account, they didn't want the incorrect people trying to flood money into these accounts, and we don't get tax revenue on those funds. So it's a real motivation to try and invest over the longer term yearly into the product.
Maybe that's where I would come in and say that's part of who's the target market is. I see two target markets. The one is for people who don't get the benefit on their contributions in tax, but they do want to save long term for retirement planning, for instance, and also for those people who've reached their maximum of a 350,000 contribution per annum to their retirement savings, who would like to make additional contributions that are tax free. So there's definitely space for that.
Yeah.
Absolutely.
Yeah.
And what is the expected rate of return on a tax-free savings account? And how does it compare to other taxable products?
So I think that's quite a difficult question to answer, because the nice thing about a tax-free savings, and I just want to say that all the information that I'm giving today on the tax-free savings is related to a 91 tax-free savings account, because there are lots of different multiple accounts. So from a 91 point of view, is an investor can actually invest in a whole range of different risk profiles. So you can go 100% equities, 100% offshore, you can be 100% in bonds, you can be 100% in cash. So it's truly can be molded to the client's need and the client's risk profile that they want to go in. And that is exactly where Christy comes in, and Spektra would come in and say, okay, I as Justin would love to take risk, let's go 100% offshore, but I can't actually manage the downside of risk. So Christy would manage me and help me go into a profile, which a model of investments that actually suits me as a person.
Structured for your needs, yes.
I think an easy way for me to look at it is to say, okay, but the returns, I always look at investments other than asset classes also on tax planning, because that's where a tax-free savings account helps. Because if you use an example of, let's say, 100,000 Rand being invested in a bank account, and you get 8% interest, that's another 8,000 Rand that is either taxable or not taxable. So depending on your personal scenario, when it's taxable, it means that the growth in the tax-free savings account is actually then your 30 or 40% higher on that interest portion because of the benefit of the tax.
Exactly.
So, but it's an individual thing that needs to be discussed with the client.
Yes.
In terms of, because we're talking about the returns on a tax-free savings account, what is the tax treatment on the growth thereon?
So that's the wonderful thing about a tax-free savings is, let's say in a normal investment, if I created a capital gain event or I earned interest in the investment, the interest that I earn in an investment and the capital gains would be added to my income for the year, and I'll be taxed accordingly to my tax rate. Where in a tax-free savings account, that all the growth within my tax-free account is actually tax-free. So there's no capital growth, capital gains tax, and there's no interest tax, which is extremely positive, and that is why this is such a positive investment to use over the longer term, because of those advantages you get over the tax, which can have a massive impact on your investments over the long term.
So also very important to realize that some of our clients, we see them make the mistake actually where they're not aware of the exemptions they get on capital gains and interest. So they go to a tax-free savings very quickly and without reason, not properly understanding the underlying taxation and the actual reason for investing in a tax-free savings account. So sometimes it's better for the client not to be in a tax-free savings because of the exemptions they get. And then after they've already used their exemptions, then go to a tax-free savings account.
Yeah, I think that's quite an important point that Christy's brought up there. Is lots of people wonder sometimes, why should I have an advisor? And that is exactly why we encourage our clients at 91 to have advisors, because the advisor is there to help you structure a portfolio and an investment plan for the future using the products. And the normal person on the street, if I to take my mother and my grandmother, they don't know anything about those different structures. And with the right and proper planning from a financial advisor firm, which can help a client, can have a major effect on, do I actually reach my retirement goal or don't I? And I think that's quite important for people to understand is there's a reason why there are financial advisors, and the reason is to guide you and have a plan to make sure you get to the right place at the right time financially, so that you are there and supported.
So that's where we at Spektra, we have accountants there that also look at tax planning, because that is a very integral part of financial planning. Because if you can get the best tax planning together with your investment advice, that is the additional growth you get on your investment that other people that don't get advice.
Absolutely. And are there any penalties on withdrawals and on additional contributions?
So if you make an additional contribution, let's say I've reached my maximum of 36,000 Rand per year, anything above that would be taxed at 40% in the hands of the investor. The main reason I think why they did that is so that people don't put all their money into tax-free savings, because that would probably happen. And to show that this is a longer term, you can add a certain portion per year and build the portfolio. there's no penalties with withdrawing from the tax-free savings, but there is a negative, meaning that, let's say I have contributed 100,000 Rand over my lifetime into my tax-free savings, and I withdraw 50,000 Rand. That 50,000 Rand that I withdraw doesn't then get added back onto the 500,000 Rand maximum that I'm allowed to contribute over the lifetime. So I'm using it up. So that's also another thing to show that this investment is actually for the longer term for the investors. They don't want them to withdraw until it's absolutely necessary, hopefully at 65, 55 or whenever they need it.
I think that is something we do pick up with clients, is because they don't understand the product, is they think they use it as a bank account.
Yes.
And they think they've got this 500,000 they can contribute and withdraw, but it's actually not what's happening, and they use up their contributions then, and by the time, and they don't get the benefit of the growth, long-term growth, tax-free on the investments. That is one of the biggest concerns. The second thing we also pick up is that clients think that their contribution is tax deductible. And that is the difference between another retirement product, for instance, and tax-free savings accounts. But so there's a few misconceptions out there that clients need to be aware of.
Yeah.
While we're on that topic, if I now want to invest in a tax-free savings account, would you say it's better for me to invest in a bank or at an investment company? And what is the difference really between a tax-free savings with my bank versus with 91, for example?
There could be a few differences, but mainly what I find with clients is as soon as they go to a bank in a tax-free savings account, the underlying portfolio is cash.
Yes.
And that is actually, we've just discussed what is the purpose of the investment. The purpose of the investment is actually long-term. It's actually many years of investment. And as a financial advisor, we know that your underlying portfolio in cash is not going to outperform any other asset class. So your growth will be, although it is tax-free, will be lower than into a well-diversified portfolio onshore and offshore.
So basically saving in a bank is limiting your access to a wider option of asset.
Also the
classes?
risk is that what we found with the accountants is clients think they can have one tax-free savings account with us and then take out another one with the bank. And that's where Justin is alluding to, that SARS looks at it and says you pay 40% tax on that extra contribution. So that's why it's also important to give the full information to your advisor on where are your assets and your investments, so that they can make a proper analysis.
Yeah.
Absolutely. Perhaps we should clarify that, because you could have more than one tax-free savings account, but the important thing is how much you contribute to it, that you adhere to the annual limits.
Yeah, and if you do it by yourself, then the risk is you must keep book of that.
Absolutely.
If you do it through advisor, he keeps book.
He keeps book of it.
Yeah.
Let's talk about wanting to transfer to different platforms.
Yeah.
Is it possible for me to transfer my tax-free savings from one platform to a different one?
Definitely. So let's say we get quite a lot where people transfer their bank tax-free savings to us because they want a wider investment universe which they can go into. And it's quite an easy process. There's an application form that gets filled in, and the transfer would happen to 91 as a cash transfer. That will not be seen as a contribution for that year. So the client doesn't have to worry that, okay, I've already contributed 100,000 Rand at my bank. Now I want to move to 91. Am I going to pay a penalty because it's above 36,000 Rand? No, that does not count. It's just seen as a transfer, and you can still add your 36,000 Rand for that year.
Yes.
So it's quite easy. Application form, everything gets handed in by the advisor's office, and we can do that transfer. And then when the client is invested with us, they'll have a much wider range of investments to choose from.
Yes.
And asset classes to go into.
Yes. Let's talk about the asset class then, which if I'm invested at a bank, obviously it is cash. And if I decide to go onto an investment platform, what other asset classes will I now have access to?
So the nice thing by 91 is as we are an investment platform, the 91 investment platform, is we are not only constrained to 91 funds that can be invested in, the underlying funds, the unit trusts. So we allow clients to invest in a whole range of funds. There's hundreds of funds that they can invest in, Allen Gray, Coronation, offshore funds, and local funds. And I think that's important, is when we look at the asset classes, cash is most lower risk asset class. You get bonds then we look at our local equity, our offshore bonds, you get your commodities, and what is the nice thing is basically all the different types of asset classes that we're discussing now are available on our platform in different funds to invest in, and that's quite nice for an investor. I think one thing that's quite unique from a 91 point of view is the 91 tax-free savings account allows an investor to actually invest 100% offshore. So what that means is that you can invest in rands and you go 36,000 rand for that year, but you invested in an allocation which has full offshore exposure, because we know that obviously there's much more companies offshore and high growth opportunities maybe offshore. And that's quite nice, especially for younger investors. They like going offshore.
Offshore, absolutely.
Also, under the underlying, I think might be prudent to come to the discussion that you get active funds and passive funds. So the passive funds is where you get index trackers, and sometimes I call them cheap and nasty, because there's no management taking place there. So you've got no input into what equities you are buying or selling.
Yes.
And when everything goes up, it's good, but when things go bad, it can bite you. So that's where the discussion with the client comes in. Does he want to have a cheaper fund, but you must be aware of the disadvantages as well, or do you want an actively managed fund?
Yeah.
That's obviously a bit more expensive, but it's got its advantages.
But 91 has access to both.
Now let's talk about the fees on tax-free savings accounts, or in relation to using them on 91 specifically. So what are the differences in the fees, and what is there to look out for?
So when investing on the 91 investment platform, there are a few different types of fees. So you have the 91 investment platform fee, the administration fee that 91 takes. You have an advice fee from the advisor. And then obviously the different funds that you invest in underlying have fees. But the main thing to understand there, I always say, is that the out of the investment account, the tax-free savings account, the advice fee and the platform fee will be paid.
Yes.
The client receives the growth from the unit trust funds after fees. Okay. So those are the two main types of fees you will pay at 91. If you maybe invested in a model portfolio, which is managed by a team of experts, they might charge an extra model fee.
Yes.
But the 91 investment platform fee, what's quite nice from 91 is, so let's say I'm invested in 91 and I have a preservation fund, I have an RA, and I have a tax-free savings plan. They don't get charged all at a different scale. They actually get charged all as one. So the larger my portfolio, the cheaper it gets to invest with 91. And I think that's quite nice. And at the same point is what 91 has done is, seeing that you can only invest 36,000 Rand per year into this portfolio, we have actually now created family pricing. It's had a massive take up. And what that allows is you can actually link a family for pricing. Because we say that if you want to give proper advice, you need to start looking at holistic planning at the whole family. So we allow a husband, wife, children, their trusts and their companies to be linked as one entity and one person. So if each one has an amount, they'll all be put together and all will be paying the lowest fee possible as a family. And that's quite nice, because fees also obviously have a great impact on your growth going forward. So 91 is trying its best to try and get those fees as low as possible for a family unit to hopefully get everyone to invest.
That's a really great feature. Crystal, maybe you can answer this one. How does a tax-free savings fit into an overall financial plan? And is there specific investment goals that you would say fit the use of a tax-free savings account?
I think it's important to realize that the best benefit you get from the tax-free savings is the actual exponential growth in your money, and the tax-free benefits at the end of the term. So the longer you invest, the better your returns and tax-free returns you get on your investment. So saying that is, you need to look at goals that are very long-term. So typically your retirement. So it could be an additional retirement investment vehicle. So to complement your retirement funds, your retirement annuities and pension funds, and also for any other types of investments you might have a long-term to save for. Typically you could use it for your children's education if you start saving for that. But there's a little asterisk there, be careful. I have found clients that have started tax-free savings accounts on their children's name, and I think that is a very dangerous thing to do, because each and every client person, you get that 500,000 Rand exemption on your life. So if you start using it on your child's name and you withdraw the money, one day when they are adults, they're going to say, where did my tax-free savings
You used it up.
exemption go?
Yes.
So be careful of that. You need advice there. So any long-term investment, the longer the term, the better. So normally it would suit a retirement goal the best.
Yes. Because we're talking about tax-free savings in relation to retirement, what's the main difference between contributions to a tax-free savings versus a retirement product where tax-free relief is concerned?
So looking at an individual client, for instance, some clients would not, based on their income, will not be paying a lot of tax. So their contributions will not. So in the retirement annuity fund or pension fund, you get the tax relief on your contributions.
Yes.
So people with a very low tax rate might benefit from actually investing into a tax-free savings account, because the money is also invested for the long term for retirement, but the money is still liquid, it's available. That's a benefit that you don't have with a pension fund. And the other thing is also on a pension product, a retirement product, you are governed by Regulation 28 that says you must invest so much there, and there's certain regulations which is not applicable to your tax-free savings account. So again, if you use both, you can get the best of both worlds. Whereas, as Justin said, you can invest offshore 100%, which is not allowed on a retirement product. And you can go 100% equities, which is not allowed in a retirement product. But the benefit of both are that the growth on both is tax-free. So that is the similarity, but it ends there, because tax-free savings account, you can get the amount as a lump sum, the whole amount, which you can't get on the retirement product. But on the retirement product, the benefits, you can deduct the contributions from your tax, but also get tax advice to see whether you still do get that benefit or it's applicable to you.
So basically the two are the main, or one of the ways in which you can invest in a tax-free efficient way, or a tax-efficient way. Okay, that's brilliant.
Yeah, so it's for me, that's why you need financial advice.
Yes.
Is because there are a lot of products out there, and everything's got advantages and disadvantages, and putting them together in a financial plan that you get the benefits of all these products in your portfolio.
Let's talk about how it fades into the picture when we talk estate planning. So what happens to my tax-free savings upon my death?
So a tax-free savings at death would still form part of the client's estate when he passes away. The nice thing about the tax-free savings, seeing it is tax-free, at least the capital gain that would be triggered to withdraw it you would not pay a capital gain. So that's quite a large positive. So, but it would still form part of the client's estate, pay out to the estate. A person can't actually, by 91, take over the tax-free savings, because as Krista said, it is per tax number or ID number that it gets done. But it will pay out to the estate, but at least there's no capital gain triggered.
Okay, and are there any potential risks or drawbacks in tax-free savings in general?
So I don't think there's so many risks. Obviously, I think the one risk is that you can't invest enough, because it's quite a nice vehicle to invest in. I think the one risk, which I would say, is not understanding the product correctly. I think that's quite a risk from an investor point of view, is to know that it is not something that I'm going to save for my holiday in 2 years to go overseas. You know, you actually want to use it for the long term to actually generate the benefit as big as possible. Get that benefit for my retirement or for a longer term goal, 20, 15 years type of goal. I think that's a risk from the portfolio. And then from a client perspective, I think from a platform perspective, I think the thing that's important, and that's where the advisor comes in, is to understand the different restrictions that might be caused not because of the product, because of the platforms, as 91 or whoever, what we can and we can't do with our systems in the background. So just to make sure that you on the most growth efficient and cost efficient platform going for your plan.
Okay. While we're on the topic of restrictions, do we generally anticipate any changes in future on the rules?
So I haven't heard of any changes. I actually tried to look, but I don't see any changes coming soon. I think they were quite impressed with how many people have went into these tax-free savings. So I doubt that we'll see any changes soon, but it would be great if they would actually increase the contribution, because I would love to put more money into my tax-free savings, but so far we haven't really heard anything.
Okay. Krista, maybe you take this one. What are the long-term benefits compared to taxable alternatives?
Taxable alternatives.
Yes. So how does the tax-free investment potentially enhance overall returns over time, and what are the other advantages of tax-free compounding in income?
So that is where it's important to understand that because it says tax-free, it's on the returns, on your interest and capital gains, you don't pay tax. So every person gets an exemption per year on interest and capital gains. So that's why it's important to realize that on a short-term basis and on small amounts of money, you don't actually get the benefit that you do get into a tax-free. It's the same benefit on both sides, whether you've got a tax-free saving or not. So it's when the amounts get large when you actually start getting the benefit. So that's why we're saying in a tax planning and an investment portfolio, we start off with a client with a normal investment just to get some money as a bit of a emergency fund there, so that if they want to make withdrawals, that's where they start. And then we'll start with the tax-free savings account, where when you invest there and the amounts get larger and larger and larger, and the growth on that gets to a taxable portion, that's when you actually get the benefit of the investment.
Okay, that's great. Is there anything you'd like to add to the conversation with regards to tax-free savings?
No, I think Christy answered everything there, but I think one thing that Christy can help with, maybe if clients have any questions, is that you can actually show them the impact when they do a financial plan, to show what could be the potential growth difference on a tax-free savings versus a normal investment account. So, because lots of people don't actually think that there could be such a large impact, but let's say you had R1 million in a tax-free and you had R1 million in your bank account, and they both earned 10% interest. I've earned 100,000, 100,000. That 100,000 in my bank account would be taxed at my marginal tax rate. Let's say it's maximum 45. So I lose 45,000 Rand there maybe. Within the tax-free, I gain everything. And that's where Christy will come in and show you exactly what could be the benefit going forward for the next 15, 20 years.
Okay, so what I'm getting...
Compound that's
amazing.
That is major. So in essence, it's very important to get financial advice on whether or not a tax-free savings is for you and where it fits into your overall long-term plan.
Yeah, it definitely makes part, and it's a very important part of the long-term plan.
Definitely.
Okay, thank you so much for the information that we got and your input. It's been a really great session. I hope that everybody got the information that they would like to learn more about. If there are any other questions, we'll probably have this conversation again, touching on tax-free or tax-efficient ways of saving.
Right, thanks. Thanks for having me here. Thanks, it was really nice, and I think these are great sessions to have going forward.
Okay, thank you so much.
Thanks, Justin. Appreciate it.
Thanks.